Hello, good evening, everyone. Looks like we've got just a couple more people that are joining, and then we'll get started. Um, all right, so we have a small group here, which is great. You guys are welcome to ask any questions in the chat as we go along. I am going to present a ton of information. Um, I will provide these slides to Maria and the team at Bridgeway, so that you can have access to them, because there is going to be a lot of information, and I know a lot of people are trying to write things down while I'm talking, and that's not always the best thing when you're trying to keep up. So, just to be aware, this is also being recorded. So if you need a copy of it to go back and reference, you can have that through Bridgeway as well. So, we are talking about business and financial readiness tonight. This is only an hour long, so I'm going to move quick. Um, in addition to jamming all of this information in here, because this, of course, is a huge topic, and probably one of the reasons that you guys are connected to Bridgeway, right? Because they are a lender. My name is Christy Dudgeon. I am the president of SBC Consulting. We are a third-party technical assistance provider for Bridgeway Capital, as well as a bookkeeping source for many of their clients. So if any of you guys are interested in having that extra support for your business outside of what Bridgeway could provide you, they do work in conjunction a lot with the work that we do, as well as helping access. So if you're interested, certainly connect with your Bridgeway Capital advisor or connection within their team, and you can get a discount when you get referred to our business. So, as I mentioned before, SBC Consulting is a bookkeeping and financial advisory firm, and we assist small businesses, probably very much like all of you, every day with organizing as well as understanding their finances, putting together business plans and projections, also doing pro formas if you happen to be in the real estate world. So, if you've not connected with someone on our team before, it is likely that you will in the future. We've got some more people jumping in here real quick. So I'm just going to let them in, and then I'm going to go right back to what I was saying. So everybody else that just joined, if you have questions as I'm talking, go ahead and drop those in the chat. If everyone wants to just say hello over in the chat as well, and list the name of your business in there, just so I can get a little bit more familiar with who you guys are, since your Zoom names are all over the place. Some of you have your business, some of you have your name, some of them, some of them it's probably not even your name, it might be your spouse's name. I've seen that before. So feel free also to connect with me on LinkedIn. I am a QuickBooks Level 2 Pro Advisor, as well as an Intuit certified bookkeeper. So in the world of finance, I do reference QuickBooks a lot, and what you could do within QuickBooks, just because it's the space that I live in mostly when I am talking financial reports as well as preparation. Um, Seeing a lot of you dropping in there. Yep, love adding the websites too. These if you guys don't all know each other, or you haven't been in the same space as each other, these are great networking as well to get to know everybody. I'm sure you're all from that Western PA area. So topics that we're going to cover tonight include how to use your financial numbers to guide your decisions. There's so much power that can be unlocked in knowing what your financial statements are telling you and what those reports actually have within them. First step, of course, is to get that information or that data organized to get those reports, but we're going to kind of jump into what those reports already say. What lenders are looking for when they are evaluating your business, and some of those common financial mistakes that might be holding your business back. So in the world of financial statements, and when I say that term, oh, we've got some more jumping in through the chat here, or through, hang on 1 second. There we go. All right, I think everybody should be in now. We're talking about three reports specifically, and those are the balance sheet, income statement, and the cash flow report, or statement of cash flows is another name for those. Why these are important is they provide a standardized review, or a standardized view. They help you compare. They track your performance over time or at a period in time, depending on the report. And they also help determine loan eligibility. So these reports, all three of these collectively, will provide you with a significant amount of information from a decision-making standpoint. So not only are we making money, what are our gross margin or our profit margin, how many assets do we have, but also do we have money coming in, money going out? Should we make a decision to purchase a piece of equipment? Do we need funding? Do we need a loan, right? These three reports together are going to be able to provide you with that information. So the first report that we're going to talk about is the profit and loss report. I consider this to be the number one most utilized report in small business, or any business for that matter, because this report is going to tell us our income and our expenses. And the reason it's probably the most number one utilized report is most of us want to know, are we profitable or not? First of all, we want to know how much money do we make? Second of all, do we want to know if we're profitable? There is so much more information that we can learn from this report than just that. But how much money did our business make? How much did we spend? And whether we made a profit or did we have a loss? Did we not make money? Right? So this report specifically shows us all of our income and expenses over a period of time. So that statement is pretty specific. We can look at it from today. Do we want to know exactly what our business did today? Do we want to see for the last week, the last month, the last year, 2 years ago, since the beginning of time, right? So over whatever period of time that we're looking at. And also another key word or phrase that I'm saying right there is since or behind, right? So everything that we see in the profit and loss has already happened. That money has already been made, that money has already been spent, right? So we could make business decisions or projections going forward off of this information. We can also create a budget off of this information. But as far as being able to change what we've already done, we can't really do that because it's already happened, right? From the profit and loss. So revenue or income is generally what we're going to see at the very top of this report. That would be things such as services that we provide, product sales that we may have, contracts, events, subscriptions, and some grants are considered income. That's why that, if applicable, is there. Always, if you're receiving a grant, you're going to want to know, is this taxable, non-taxable, and where it should be actually placed within your bookkeeping. Expenses, this is money that we have spent to operate and can include something that's called cost of goods sold or materials. Those are our direct expenses. Also, as well as our indirect expenses, such as payroll, rent, marketing, software, insurance, utilities. Those are all very common expenses. Professional services, which might include your accountant or bookkeeper, your attorney. Those are all professional, any consultants that you work with. So I put recall. There are two types of expenses, whether you are aware of that or not, but I did just mention them as far as direct. So those are costs that are generated, that directly generate the sale or the outcome. So if we had to purchase a product to sell it, that's a direct cost, right? If we had to purchase some raw materials and create that product to sell, that's a direct cost. If we needed materials in order to build a house or do landscaping or, for a contractor, and we had to buy the equipment that we're installing, those types of things, those are all considered direct cost or those cost of goods sold. And then we've got all those indirect costs, which actually end up being the bulk of the line items that we'll see on our profit and loss. And those are what we also call overhead. So you might have seen both of those phrases. And those can be fixed or variable. And these are general operating costs. So it doesn't matter if we sell anything in our business. We are still going to have these associated costs. So an example of a fixed cost would be like rent. Because we typically would have to pay that same amount or our lease for our office. would pay that same exact amount every single month. Variable costs out there can be, maybe our advertising expenses, our bank fees that we have to pay each month, depending on what type of accounts we utilize, right? If we're accepting credit cards, those could be dependent each month as well. So in our profit and loss report, the thing that most of you, if you're just starting out looking at this report, are going to be able to recognize and see is that income is going to be listed at the top block. Then we're going to have all of our expenses. And then you're going to see the bottom line, this is why it's called the bottom line. And that's our profit. So we're going to know whether we've got a profit or loss based on what that bottom line tells us. So this includes that revenue minus expenses equals that net income, and that's how that number is determined. So if we are breaking even, I guess is the phrase, that means our income and our expenses equal each other, and you'll see a 0 near the bottom of that report. Or we see a positive number, that's profit, or a negative number, that's a loss. So it's important because we need to know if we're making money. We're going to know if we're able to cover all of our expenses, at least from the expenses that we're going to be able to see on the profit and loss. And we'll talk a little bit about what we won't see on the profit and loss. We can look at our changes in our expenses over time. It's amazing when you finally start to organize your data and see it all lined up on a report like this. You might not realize how much you're spending in subscriptions. That's one of them that gets you, right? Because it's so easy for us to add a new subscription all the time that we don't see exactly how much that's costing us every month until we're really looking at it in one of these reports. We'll also be able to tell what's our most successful product or what's our most successful revenue if we have multiple lines of revenue. And also if there's something is a good investment, we can tell by looking at that as well. So what do we want to review? So if you're new to looking at this report, you've never seen it before, never put one together, it could be pretty scary to look at it for the very first time. But we want to know, does our income look accurate? This is always a shocker. Sometimes when someone's looked at this report for the very first time, it's like, oh, I made a lot more money than I thought I did. Or, wait, that's not right. That's a lot less. And that's generally because you're looking at your bank account, right? So you have a pretty good feel of the money that's come in. So when you start to look at this report, you might know if that looks off or not. Do any of the major expenses make sense? So as I mentioned before, everything is going to be in lines on this report. And so we call that your chart of accounts when you're organizing things. Basically, they're buckets that you put these different expenses into. And so you're going to be looking at these different buckets. And when you start to look at it, you want to know, does that make sense? Like, did your advertising costs really, did you think they were really that? And so you'll be able to break down each of those buckets and start to look at them a little deeper to know whether or not they really make sense. Are there any unusual or missing items? This is pretty common when you first start looking at it as well. There might be a line item of something that has a value on it that you say, I don't understand what that is. And that is your prompt to go look a little deeper to see what's really in there. Also, is there errors in the categorization? So the putting of things into those buckets or those accounts is called categorization or classifying those expenses. And there can be a lot of errors if you're starting out doing this for the very first time. And that being that maybe it was a loan payment and you called it an expense. That would be an inaccurate or an error in categorization. So those loan payments themselves are actually going on to a different report called the balance sheet, which we'll talk about here in a minute, not an expense. The interest that you pay on a loan is an actual expense, but the payment itself is not. So making sure that we know where to get those in the correct place allows us to have an accurate report. And so that's why we want to look at these reports so that we can ensure that we've got the numbers in the right place and things are accurate. Certainly, if we want to hand this report over to a lender, we want to make sure that we've got things in the right place and that they are accurate. So this report will answer, as I mentioned before, am I making money? And that's purely from that bottom line and profitability. What else can we learn from this report, though, when we look a little deeper? So there's more than just that. We can look and see what our gross margin is. So that's that income minus the cost of goods sold or those direct expenses. And then we can see our profit margin. So we've got two different margins, and we're going to go a little bit deeper into those. We can look at trends over time. So maybe we have a seasonal type business, and so our revenue changes throughout the year. Maybe our expenses are changing throughout the year, and we can start to see those different trends that happen within our business the more often that we look at this report. We can also tell if there's certain pricing problems. So maybe our pricing is too low, maybe our pricing is too high, and we'll be able to start to identify those based on this report. We can also see growth patterns. So how our business is growing. We can see the impact of our marketing. So maybe our advertising dollars are going up. So obviously we want to see a return on our revenue. So we're going to notice those trending up together, ideally, if we've got our marketing on point. And then also different cost control opportunities. So depending on how lean you run your business, and lean being that your margins are very thin, which a lot of us in business they tend to be. Most of us aren't overly profitable and have all this money that we don't know what to do with. So we're running pretty lean. We can start to identify those different buckets where we can start to control our cost, either that being with our direct cost, so we're controlling maybe labor and materials that are going into producing the outcome of that sale, right? Or we're looking at things like subscription cost or advertising, maybe our insurance cost, right? We haven't talked to our business insurance person in a while, and we maybe need to shop that out and see if we can bring that rate down. But when you start to see all of this lined up, you can start to make those cost control decisions on a larger scale. So profit margins, I mentioned this word, but that's really the profit margin tells you how much of each dollar you keep after covering all the direct or indirect expenses. So basically what that means at the end of the month, the year, whatever, maybe however you're managing your business, either this is money that's going directly to the owner or it's a reinvestment type thing, right, into the business. So it gives you a pretty good expectation of what the value of the company is starting to be coming to you. Obviously, the more profitable you are, the more valuable your company will start to be, right? To not only yourself be yourself, but also in the future if you potentially decide to sell it. So if your business earns $100,000 in revenue and your expenses are 80,000, then your profit is 20,000. To get our profit margin, the margin is actually a percentage. We just do quick division there, and that tells us that our profit margin is 20%. Margins help us answer things like, are our costs too high? Obviously, the lower the profit, it's either going to be one of two things: our pricing isn't high enough, or our costs are too high, right? So those two things have a great effect over whether or not our profit margin is what we want it to be. And are we becoming more efficient over time? So if we have a goal to have a higher profit margin year after year, or as the year goes along, then we're going to want to know if we're becoming more and more efficient over time. Revenue alone doesn't tell the story though. So when I work with small businesses, one of our first things is we focus on how much money we're going to make as a small business. And, that $100,000 threshold is usually the first goal that everybody wants to pass. Then it's 250, then it's 500,000, then we hit a million, then we start talking to, and we go on from there, right? And so those are exciting milestones to hit from a revenue standpoint. But it doesn't always tell the story. I've worked in businesses before, or with businesses before, where they had huge growth goals from one year to the next. And guess what? At the end of the next year, we made actually less money having more revenue, right? And that's because our costs are higher, or we were running inefficient, trying to hit that next level of revenue. Definitely not the goal to work harder and do more and actually take home less money, right? So be aware of that as you're setting those growth goals over time. So there will be a sweet spot though at each spot, or at each phase of your business, where your overhead is kind of in alignment with where your revenue is. And that's generally why a lot of people want to get to that 100,000 mark, because you've got that overhead regardless, right? So you need to cover overhead plus direct expenses and then hit your profit. So this example here, business A, revenue $100,000, total expenses $95,000, net profit here is only $5,000, profit margin of 5%. Not a great profit margin here, right? Or net profit. Business B maybe has a slightly different strategy, slightly different model. Maybe they're controlling costs a little different way. They've only got $75,000 in their total expenses, so their net profit is $25,000, and their profit margin then is 25%. On paper, obviously, this company looks a lot different. Business B between business A. That's maybe money to the owner's pocket. Maybe it's a reinvestment into new product lines for the next year and growth. So definitely $20,000 on a 100,000 could make a huge difference. So which business would you rather own? I can tell you I would rather be part of business B, at least at this point. The other margin that we talked about was gross profit and that gross margin. So what really is driving profitability? Gross margin is going to tell us whether that core product or service itself is profitable. And it's what's left after we've paid all those direct costs required to produce our product or deliver our service. Those are what is called those cost of goods sold. And these costs might include things like materials and inventory, feed or seed, packaging, subcontract labor, direct production cost. If you guys ever watch Shark Tank, I get swept up in that all the time because I can talk business all day long. One of the first questions that they always ask is, what's your gross margin? They very rarely actually ask if the company is profitable. They want to know what the gross margin is first, because obviously, if that gross margin is healthy, most likely it's leading to a profitable company. So that's why that gross margin is driving profitability. And gross margin certainly varies depending on the type of business that you have. Whatever your profit margin is going to be also varies by industry. So it's difficult to just say everybody should be shooting for this or that, because that is industry specific and what you can expect. But there is a lot of data out there if you're new to trying to figure out what your overhead should be and what your direct cost should be based on the type of industry that you're in. You can get a pretty good idea based on those percentages, and then you can try to work within that until you've got a better idea from an operational standpoint. So this is gross margin versus profit margin of these two businesses again. So we've got business A, they've got a cost of goods sold of 60,000 versus business B with their 40,000. So you can see the difference in those gross profits. Both of them have the exact same overhead expenses at 35,000. So one of them is just controlling those direct costs a little better. They might have a supplier that, they've got terms that they're working with, or better rates that they're receiving. Maybe their labor is a little bit lower for those direct costs. So they're just managing their business a little bit different from that aspect. So you can see how those net profits then shake out. So knowing that middle piece, as I like to call it, because we've got revenue at the top, then we've got those cost of goods sold. So we really can watch that central line first, to be able to determine then profit margin. It can be pretty difficult in the course of business to control fixed costs, because those are pretty standard, right? Rent, although you may be able to negotiate rent and insurance and things like that, those are going to be standard throughout the year, and you can easily budget on them. It's those variable costs that are the ones that you really want to identify and keep a handle on, and keep those under control. If you don't have someone that's great that's purchasing for your direct expenses, that can really get out of control as well. So I've spent a lot of time in the landscaping industry, and the variability of a tree from one company to the next, right? And being able to understand your suppliers and those costs associated with it really affect that gross margin that you're working with. So gross profit versus net profit. So if a gross profit is weak, your pricing may be too low, material or product costs may be too high, production or service delivery may be inefficient, and supplier costs may just be too expensive. If a net profit is weak, overhead costs may be too high, administrative or fixed costs may be growing, staffing levels may not match the revenue, and the business may be carrying too many subscription services or overhead expenses. That staffing levels may not match revenue is also a big one. So knowing what your optimal staffing is for efficiency. So I can speak to this from the landscaping world too. Dealing with anything that the weather would affect your staffing levels, also the seasonality of a business, that depending on how many people you need at a certain time of year, right? And so then you've got things like overtime that might come into play. And anytime you're not at the correct staffing level, you're either overpaying for the number of people you have or you're underpaying, or you have less people than you need, and then you're tapping into overtime. And so there is a lot of cost control measures that happen in companies like that in order to maintain that gross margin as closely as possible. What strong margins can indicate then? Products and services are priced well, direct production costs are controlled, supplier materials are efficient, the core offering is financial healthy. If the net profit is strong, the overall business model is working, overhead costs are being managed efficiently, the business has room to reinvest or grow. I've mentioned that many times about profit margin. And the owner may have flexibility for hiring, expansion, or savings. So we can make better decisions when we've got some money to work with, right? We can also see our expense patterns in the profit and loss. It's going to show us where the money is going. Are our payroll costs increasing? Are the supplies costs rising? Is marketing producing results? I mentioned that one before. Are subscriptions or software starting to add up? This is where business owners often discover things like those small reoccurring expenses that started to become big ones. Also, cost increases that they maybe didn't notice right off the bat. And then areas where spending might be reduced, as well as those bookkeeping errors that I talked about before, things that just aren't categorized in the correct place, or we've got our accounts kind of out of alignment. The second report that is probably what I would consider to be more important overall than the actual profit and loss. And that's because this is what tells us whether or not we should be spending money at any particular time. And this helps us make decisions more into the future, where the profit and loss is telling us what already happened, right? The cash flow report is telling us truly what money is coming into our business and what money is going out. And it gives us a better idea what might be happening this week, next week, depending on how well we are using our financial software or our systems. So again, data's got to be coming in well in order to tell us what these reports look like. So the cash flow report is really telling us if our business can survive. So this is the actual money coming in, actual money going out, and the timing of that cash movement. So it helps with visibility and it helps prevent panic. We don't like to get to the point where we have nothing in the bank account and we've got a loan that we've got to pay, or we've got payroll. Better yet, I've been in that situation. I was there when I owned my own small business many years, 25 years ago, my first small business. I just had a cash flow issue. I was expecting a large contract to come through from a payment. It didn't. I had payroll that I had to pay. I mortgaged my house. That's, this is the types of things that we do as a small business owner. So I have definitely been there in that panic moment. But you have to pay your people, you have to pay your vendors. That's the way you keep your business rolling. Cash flow is all about timing. So a business can be profitable on paper. This happens often. We've got great profit on paper. Remember, the profit and loss only tells us so much of the story, but we're still struggling financially if the timing of our money coming in and the money going out don't line up. Very, very common. So will I have enough cash to pay my bills when they're due? Cash flow includes things the profit and loss does not show us. So what's the timing of our customer payments? So do we invoice people, which means we've given them an invoice and they're going to pay us at a later date. That's called accounts receivable. Cash flow, as long as we've got our invoices in the system or we've created them in a cash flow report, is going to tell us when we're going to expect those payments. So maybe our invoices are due in 30 days. So therefore that clock is going to be ticking, right? And that's going to show up on that cash flow report to say when we're going to expect that money to come in. So as I mentioned, my contractor that didn't pay me as expected doesn't always happen that way, but at least it's creating us that expectation of when something could come in so we can better plan when we will then pay for different things. So bills that we owe to suppliers. So if we're working on terms with our vendors, which is a great way to help manage cash, right? So we're not going to a supplier and paying for it at the second that we're receiving the goods. Instead, we're on terms, right? So same thing, we're invoicing a customer, they're invoicing us as a customer, so we're not going to pay them for 30 days, right? And so we can stretch out that payment a little bit further and help manage that cash flow. Loan principal payments. So loan principal payments are not going to show up anywhere on our profit and loss, and they're not going to affect the profitability either. So we definitely need to be able to see visibly when are we going to be paying those, or when or would we be paying those. Same thing with credit cards. If we're using credit cards to help manage our cash flow, we need to know when those credit cards are due, so that we can accurately pay those payments. Different equipment purchases. So I like to tell the story. One of my bosses, one time, we had money in the bank. He went and bought a boat with that money instead of going, oh, do we have bills that are due? Also, why he was no longer managing the cash flow of the business himself. He was one of those people that saw money in the bank and decided to spend it. Not exactly an equipment for the business, but it was for him. However, there that created cash flow issues, as opposed to seeing the true visibility of what was coming forward. Owner draws. So this is when we pay ourselves as the owner, or we want to withdraw money from the business for whatever reason, right? We can do that as owners. The cash flow report is definitely going to be the key to letting us know when and when we should do that, right? And how much we can do. As well as inventory purchases. So depending on what our business looks like over time, we might want to purchase inventory this month for something we know that's coming up in 2 months, right? Because we might have a better rate. There's cost savings and off seasons and things like that that we can start to exercise. This is all in helping bring those margins to where we want them to be. But the cash flow report is definitely going to tell us if we're able to do that now, or we need to do it later. And so if you've not seen a cash flow statement or a cash flow report before, this is basically what one looks like. There's a link at the bottom of this that will take you directly to this. This is actually it downloads into Google Sheets. And this is all manual entry, right? You're putting numbers in here, but at least it's telling you what your estimated cash flow is looking like. I like to look at it even deeper than this. So, starting with at least the month ahead is a great start if you've not done one before. But I really like to look at it even week to week because of the variabilities that can happen within business. But this is a simple cash flow example here. And it can let you know what can happen within business from month to month, right? So in the first month of the year, we're only expected to bring in $5,000. We've got $40,000 in expenses that are due, so we're at a deficit of $35,000 in our cash flow. So that money had to come from somewhere, right? In order for us to be able to pay that $40,000 bill that we were dealing with. So most likely we had some kind of balance headed in. So we've got that starting balance that we know what our cash was, and then we've got an ending balance at the end of the month as well. So we could see that money moving in and out. So we're at a $35,000 deficit already. Month 2, we're expecting $15,000 to come in, $20,000 to be paid. Now we're at a net -5, so we're net -40, right, at this point, if you're keeping track. So definitely we needed money in the bank or a credit line or something of that nature that was supporting us through this. By month 3, we finally have this revenue coming in, with expenses paid to be less, and now we're at a net cash of 25,000. Then month 4, we've got 90,000 coming in. Our expenses are low again here, and now we're at net 75. So we're able to pay back a credit line, or we're able to reinvest back into the business. Bank account now is starting to look a lot healthier at this point. All the while, we could have been completely profitable this whole entire time. But we know that we were definitely spending more money than we had coming in, and this gives that picture of what we can do and when. And cash flow can swing dramatically, and that's obviously based on the type of business that you are. Not all of us are, every month doesn't look exactly the same throughout the entire year. Early in the season or early in the year, expenses come first from inventory, often supplies, preparations costs, revenues may arrive way later. Maybe we were performing a pretty big job, for a contractor or a service person in that month one, but we didn't get paid until month four. But we were definitely buying materials, and we had labor that we were paying for, in order to generate that money that we finally received in month four. This is more what weekly cash flow can look like. And often when we're first starting out in business, this is really the world we want to live in week to week. So week one, we had no money coming in, but we had to pay 8,000 in our payroll, our rent and supplies. Week two, there's 2,000 coming in, 6,000 going out. This is vendor bills that we had due. By week three, we knew we were going to make $12,000 to coming in, 4,000 going out. Customer invoices finally got paid. And then week four, we had a difference of 3,000 and 7,000. So we still had payroll and loans. So if you're tracking along with that, the money coming in, money going out might end up being close to equal to each other. However, the timing of when those are hitting is very different. Week one and week two might require a lot of cash before the revenue arrives, right? And then week three might bring in those payments. So without planning, that early gap can cause a lot of stress and force use of credit cards or emergency borrowing. We definitely don't want to be in the emergency borrowing world if we don't need to be. So common cash flow pressure points can be those slow customer payments, or maybe we had that expectation that we were going to receive a payment and we certainly didn't, right? And so we're chasing money. Large inventory purchases that we might have to make in order to complete a job or start a project. Payroll timing. Payroll is always a big one. So we know payroll is going to hit at a certain time every 2 weeks or every week, right? And so we've got to be ready for that. Loan or equipment payments, seasonal revenue cycles, rapid growth. I also want to mention on here tax payments. So I've been in a company before that literally was selling equipment off their front lawn because they couldn't make their tax payment. Also the same company that the guy bought the boat. Might explain the behavior that was happening there. I can say though, even though I talk really bad about that business, they sold it for $55 million. So they were in a spot that was obviously not so pretty at one point, but they turned it around and ended up, now they have homes in Fort Lauderdale. So different world, and that really had to do with understanding their operation structure and changing the way they were doing business. So many businesses that struggle with cash flow or profitability or that are profitable, right? And so at the end of the year, it looks like they were doing a great job. However, they're struggling to pay their bills. So this is called the cash flow gap. So this is when we've got things going, but we don't have the cash, right? So there is a gap in that flow. Again, this is a breakdown. This is looking at 6 weeks, what might happen. So we've got cash going out, still no cash, right? Still no cash. Finally, on week 6, the cash comes in. And so we're able to finally close that gap. And we talked about before how many businesses cover that gap, and that's existing cash reserves is obviously a big one. We want to make sure we have enough cash to cover that gap. And if we can see it into the future, we can better plan for it and ensure we have enough money in the bank in order to cover that gap. Lines of credit is another way. Credit cards, customer deposits. So maybe we weren't having customers give us a deposit for those bigger jobs that were waiting months to be paid. Maybe we're invoicing more regularly. So we're changing or improving that invoicing process and shortening those payment terms. As well as if we're utilizing our vendors a little bit differently, if we're able to have those terms and stretch those payments out as well, that's going to help us with the cash flow standpoint. So the third report that I had talked about on there is the balance sheet. And so the balance sheet is going to show us what the profit and loss does not. The cash flow is just telling us how money is moving throughout the business, but the balance sheet is showing us all those things that we didn't see on our profit and loss. And those are our assets. So this is what the business owns, our liabilities, which is what the business owes, and our equity, and that's the value of the business to the owner. And it shows the business financial position and is a snapshot of your business on one specific day. So as the profit and loss report, we pull it for a period of time, and we can do lots of different things with the profit and loss report. Balance sheet is what is it as of a day. And that's because these are all loan balances or asset balances or equity balances, right? So these are true numbers, true things of value, and they all have a balance on any specific day throughout time. So it is called the balance sheet because it's an equation and it always has to be in balance. So you can see the equation there kind of in the middle of the screen. It is assets equal liabilities plus equity. So assets are things like what are our bank accounts, our cash that we might have on hand, equipment or machinery, land. Liabilities are any debt or loans that we have, credit cards, our accounts payable. So this is, bills that we have to pay, taxes that we have to pay. And then equity is money that you, as the owner, have invested into the business. So every dollar that you put into the business, you want to make sure you're accurately recording that in your books as an owner's investment so you can have that paid in capital. It's also going to show whatever our owner's draws were. So we as owners, and this is dependent on the type of business that you have or the business structure, but the majority of us are actually going to pay ourselves with something that's called an owner's draw or owner's equity. So we're not an expense to the business as an owner. So we're not going to show up on the profit and loss report. And it's not going to affect the profitability for us to pay it. So a balance sheet can't capture everything, but it does determine the financial health of the business. It helps obtain loans. It values the company, and it monitors changes over time with all of those balances. Why accuracy matters is that if the numbers are not accurate on a balance sheet, it can mislead financial decisions. You can have incorrect tax filings. Your loan or grant applications will run into major problems because, of course, they're going to verify what the values of all these are. Cash flow surprises again. So maybe we're looking at just income and expenses, and we weren't looking at loan payments or credit card payments or accounts receivable or accounts payable or taxes that we might have payable, because that's all going to show up on our balance sheet. And difficulty understanding what the true value of business value is. So accurate books start with what's called reconciled accounts. So when you're maintaining your books every single month, you're categorizing all of these expenses, which means you're getting them all in the right bucket. Is it an asset? Is it a liability? Is it equity? Is it income? Is it expenses? And then at the end of every month, you are doing a process that's called reconciling. And that reconciling is making sure that all the values of all those things that you were dealing with throughout the month match back to some kind of statement. So we've got bank statements, we've got loan statements, credit card statements. So we can confirm that all those values are correct. And then we have more confidence at that point, once we've gone through that whole process, that the information that we're looking at is correct. I work with a lot of businesses that they might be confident in their profit and loss, but they lose a lot of confidence when they go over to their balance sheet because those accounts can be a little bit more difficult to understand. But we need both of them to be accurate, because if it comes definitely to funding, the balance sheet is going to be heavily looked at, scrutinized from a funding standpoint, because this is truly where what we owe and what we own is listed in there. So common red flags. Asset balances should never be negative. So every asset has a value, and it's not a negative one, it's a positive one. Any of our loans wouldn't have a negative balance either, right? We won't overpay a loan. It would get to the point where it's just zero. Incorrect account and detail types. I see this often. So accidentally, when we added a new account in our financial software, we made a liability an equity or an asset, or we made an expense an income or something like that. We might have those in the wrong place. Very old receivables. So maybe we've got invoices that we created 2 years ago that somebody hasn't paid, and yet we've still got those showing up on our balance sheet as if they're collectible, and they're not at this point, right? We might chase them forever, but at some point we've got to let those go, unfortunately. And so we do something that's called a bad debt write-off. And at that point, it actually, we can take it as an expense to the company. But we definitely don't want those sitting there as a receivables, because then it looks like we're actually going to collect that at some point, and that is looked at as a potential asset. So those need to be gone. Payables that seem incorrect. So maybe we entered bills in there. We've already paid them. We just didn't actually pay against the bills, or receivables or our payable is still sitting there. Questionable withholding accounts. So if we've got point of sale systems, or we've got e-commerce systems that maybe we've connected, there's withholding accounts or clearing accounts in there, payroll withholding, sales tax withholding. We need to make sure that each month our sales tax withholding is correct, as well as our payroll, and that things are being paid down correctly. Large unexplained equity balances. So equity, remember, is owner investments or owner draws. Those can also be the opening balances to accounts that we may have. We don't want those to be something that we can't explain. We want to be able to explain those. Loan balances that don't change. That means that we've entered a loan on our balance sheet, but we haven't actually put the payment of the loan against the balance. So that should definitely always be coming down. And then missing accounts. So maybe we didn't put our assets in there that we have, and maybe we didn't put our liabilities in there that we have. And so we need to make sure that those are all in that report. But balance sheets, how we can tell more information other than just what we're looking at, right? So we can see the surface values, we can see what the value of our assets are, our liabilities, and our equity. However, we run ratios, or we do these different ratios to truly get a picture of the health of the business. And they can help us answer things like, can the business pay short-term bills? Is the business carrying too much debt? That's a debt ratio. You might have heard that a lot if you've tried for funding. And is the owner building equity in the business? So they want to see that equity growing. Financial ratios also determine financial stress early, understanding someone's borrowing capacity, help to prepare for loans and grants, make better expansion decisions, and build that long-term financial stability. So a couple of the ratios, the more common ones, one is a current ratio. This helps us know, can the business pay the bills? This is literally taking our current assets, dividing it by our current liabilities. So the difference between a current and a long term is the length of time. So anything current would be considered what is within the next 12 months. So when we talk about liabilities, you may have a loan that's 5 years. However, there's a portion of it that would be due in the next 12 months, right? So that's how we get that current number as opposed to long term. And this shows us our ability to pay our short-term obligations. So current assets typically include cash, accounts receivable, and inventory. And then current liabilities are bills that are due. So those are accounts payable. Any kind of short-term debt, credit cards, those are within within that 12 months, right? And taxes payable will be within that 12 months as well. If the ratio falls below a 1, if you do this number, it means the business may struggle to cover those short-term obligations. So less than 1, that's cash pressure. Around 1.5 to 2 is considered generally healthy, and very high means that cash may not actually be used efficiently. So very high is not always the best thing. Debt ratio, this is one that maybe you've been denied for funding, and they've said you need to get your debt ratio down. This is what this means. So your debt ratio is your total liabilities, so not just current, that's all of them, divided by the total assets. And this is how much of the business is financed by debt. This is what it's looking for. So if a business has $200,000 in assets and $100,000 in debt, the ratio is 0.5. That means half the business is financed through debt. So below 0.5 is considered to be a lower financial risk. 0.5 to 0.7 can be moderate. And then 0.7 means it's a high financial risk. That's a business that's definitely financed by debt. And then we've got the debt to equity ratio, and that's the total liabilities divided by the owner's equity. And this is the balance between borrowed money and owner's investment. So definitely when we're talking about loans and funding, the equity portion comes into play. So there is always an equity contribution that's generally discussed, and that's different from lender to lender. And so that's one of these things that they're looking at here. So this ratio shows whether the business is primarily funded by the owner or by lenders. And so if debt is very high compared to equity, then the business may be more vulnerable during slow periods. So a low ratio means the owner's equity is strong. A high ratio means the business relies heavily on borrowing. So how do we prep for loan success and repayment readiness now that we know these three reports and kind of what we're looking for? So are we ready for a business loan? So banks are evaluating three different things. They want to know, do we have the ability to repay it? Are we financially stable? And they also want to know our credibility in our organization. Getting approved for a loan is only the first step, but being ready to repay it is really what protects your business, right? A lot of people will access capital at the moment where they're panicked, right? That's that emergency borrowing. That doesn't lead to much credibility, right, or organization in your organization. So, and or maybe your ability to repay. So keep that in mind. The things that you will likely be asked for when it comes time for funding. One is going to be those financial statements, particularly the three that we just talked about. So there's also some others that might be thrown in there, but definitely those three are the big ones. So this is helping lenders evaluate profitability and your stability. So typical requests, profit and loss, current year to date profit and loss. So where do you stand as of today from the beginning of the year? Balance sheets, those often are for the last 2 to 3 years, same as those profit and loss. Current balance sheet, cash flow projections are sometimes required. It depends on where you are with your business, right? So you might not have been around for 2 to 3 years. And so you're leaning a lot on a business plan and projections in order to tell that financial story then. Accounts receivable aging, if you're invoicing, accounts payable aging. So we want to know what those bills are, how far they're out, who do you owe, and how much. Lenders analyze these to determine whether the business generates enough income to cover those loan payments. Business tax returns. So prior years, up to 3 years of our business filings. This is our reported revenue, our expenses, our business activity, our financial consistency. So they're often used to verify the financial statements that you've submitted. So those should align with each other. Definitely the profit and loss is going to align right with your business tax return. The third thing would be your personal financial information. So if you own 20% or more of the business, lenders are typically going to review your personal finances as well. So common requests are those personal tax returns, personal financial statement, your personal credit, a driver's license or an ID, a resume maybe, and professional background. So they're checking in to see who is this person that owns this business, and are you capable of leading that business, right, or achieving what it is that you say that you're going to achieve. It all helps to tell that story. They review personal finances because owners usually also have to provide a personal guarantee on an SBA backed loan. So if you're with a lender that is doing SBA type financing, very, very common in small businesses, right? There is that personal guarantee that comes with it. Next is your credit history. So I did mention credit. Yes, lenders will almost always review credit history. It typically includes your personal credit score, credit report, and debt obligations on the personal side. So credit history helps lenders evaluate repayment behavior and financial discipline. A business plan or a loan narrative. Many lenders request a written explanation. This is your business history, products and service, marketing opportunity. Business plans are big pieces of information, right? They can take a lot of time to put together. They often have financial projections in them as well, and certainly helps a lender make that decision that maybe your financial statements, especially if you're a new business or a startup, that they aren't going to be able to tell that story for you, right? And so this a good business plan with solid financial projections is one of the keys to getting financing in a business startup, especially important here. Legal business documentation. So, do you have business licenses, articles of incorporation, right? Do you have an EIN number, your ownership breakdown, any kind of franchise agreement if you're in that world? Debt and liability. So they want to know what liability, what loans do you have, right? You're going to list those out, what the current balances are. You're going to provide statements for those types of things. Collateral information. So some loans are backed by collateral. Maybe the business already has assets, equipment, real estate, things like that. And so they need to know whether or not they can sell off assets in order to repay that loan if necessary. It helps reduce the risk. Also, your banking history. So, most likely, you're going to have to supply bank statements to back up what your accounts are. They help revenue, deposits, cash flow patterns, account management. They're going to ask you questions if there's any large or weird deposits that are happening. So, signs that your business is loan ready. This is accurate financial statements, consistent revenue history, organized financial records, clear purpose for the loan, realistic repayment plan. Lenders are typically looking at these reports for these reasons, and this is how you can know if you're loan ready. Are your profit and loss statements accurate? Is your bookkeeping organized? Do you have consistent financial reporting? Does your revenue support your operating expenses? Do you have a sufficient margin to handle those loan payments? Personal, responsible financial. Do you have separate personal and business finances? That one is huge. You do not want your personal finances to show up anywhere in your business reports. That's a very common mistake. Awareness of your current debt obligations. You don't want a random debt obligation to show up during the application process for a loan. Clear purpose for the loan. So that specific plan on how those funds will be used and an explanation of how to invest those supports that growth. And a realistic repayment plan. So understanding monthly loan payments, confidence that the business can sustain that. We've got just 5 more minutes. I'm going to run through these pitfalls real quick, but remember, if you have a question, go ahead and drop it in the chat and I will try to grab all those. So common pitfalls, always number one, not reviewing your financial reports. So if you're looking just solely at your bank account to know if you've got money, then you're missing out on a lot of opportunity to understand your business and truly grow it. Remember the story of the business that was selling the equipment off the lawn and then sold the business for 55 million? Clear changes happened when they started organizing and managing their financial information, and really truly paying attention to what was going on. So to put the bank balance alone, it does not show what your true profitability is, your upcoming obligations, and your expense trends. Financial reports provide a much clearer picture of how the business is performing. And the better that you get at reviewing them, the more you're going to start to understand what's happening in them, and you will start to see the changes. Most of the businesses that I work with, they have that aha moment where they go, "Oh my gosh, do you remember where I started and what has happened to me since we first started looking at these?" Pitfall number two, mixing personal and business finances. I mentioned that one. So inaccurate financial records, tax complications, difficulty qualifying for financing, confusion about true business performance. Separate accounts really help create financial clarity. Lack of cash flow planning. Without cash flow awareness, you're going to struggle with seasonal slow periods, unexpected expenses, delayed customer payments, things like that. This really helps you prepare for those different fluctuations. Waiting too long to seek financial support. So this is where that emergency financial support might come into play. So we try to solve a lot of our financial challenges alone, but professionals, right? We think a bookkeeper is too expensive, an accountant is too expensive, those financial advisors, when really the good ones are not only going to help us organize our information, but they're also going to help us grow our business, right? Because that's their role. And that's dependent on the person that you align yourself with, right? So everybody's got their strengths, but they can help you improve financial organization and decision making. So it don't always have to go it alone as a small business owner, although it feels like we're there. If you have questions, it looks like there's a couple that dropped there. But if you need bookkeeping or financial advisory help, please talk to Bridgeway. Obviously, if they refer you to us, as I mentioned before, everybody receives 10% off for their first 6 months of bookkeeping and financial advisory with us. All of our bookkeeping does include financial advisory. So not only are you going to get organized financials, but you're going to also know what to do with them, and we'll help you make business decisions, right? So contact your Bridgeway representative for that information. It looks like the question that I have in the chat is, do you know of a good marketing company? That's, and right, but good marketing companies are like good bookkeepers, right? It's interesting to find one. In your, I'm going to assume you're in Western Pennsylvania. I actually was just talking to another Bridgeway client that
Yeah,
had
I'm in Pittsburgh.
Pittsburgh. Okay. So I'll get back to you with an answer because I was just talking to another Bridgeway client yesterday that was raving about the marketing company that they had worked with, and it made a true impact on their business from a revenue standpoint. And I like to refer good companies, right? So let me get that information to you, and I'll email it to you so that I can get you the actual name. Government in contact with you, want to have a meeting with you. What is that?
Oh, my bad. I don't know why that got put down. I was saying I wanted to have a meeting with you so I can just learn a little bit more because basically I want to get a loan for my marketing. So, because
Oh,
basically, but
got it.
basically, basically my business is a t-shirt company that sells mugs and other stuff like that.
Okay.
And basically, I'm not getting any sales. So I'm hoping to get a loan for marketing so I can get some sales.
Got it. Okay. So anybody that needs help like that, right? So anything with business growth, because Bridgeway is, the sponsor of this, they do provide technical assistance, and they do provide different levels of programs and things. So definitely, I will absolutely find the name of this marketing company because it looks like someone else wants it as well, so that I can share that. But if you need help with that specifically, I would talk to Bridgeway and ask them if they can help you in some way with that meeting with me. I guess I'll put it that way, or my team. I would definitely go to Bridgeway first. Any other questions before we jump off? All right. Looks like maybe no. Well, it was great to see all of you. I know there are several more in this series, so maybe I will see you guys in the next workshop, or two or three. So thank you for joining. Follow up with Bridgeway for the recording as well as the slides as well. Thank you for the email. I will make sure that I get that over to you. Thanks, guys.